Well, China's stock markets have not been doing as well as small and medium companies. The last month has been particularly brutal for the Shanghai Composite after it plunged 30% from early June, though it has recovered some ground. Now, some investors are trying to recoup their losses through a pilot program linking markets in Hong Kong and the Chinese mainland. Cathy Yang is live in Hong Kong. Cathy, what are some of the lessons learned by investors participating in the Shanghai-Hong Kong Stock Connect scheme?
Michelle, when Shanghai and Shenzhen sneeze, the Hang Seng Index catches a cold. That's the way it's always been. But after the recent market correction on the mainland, the Hang Seng sank to levels not seen since the 2008 global financial crisis. It was also worrying, Michelle, because the correction occurred after China inaugurated a program that enables Hong Kong investors to trade more freely in mainland stocks and vice versa. So investors, rookie and veteran alike, say that they've been learning some tough lessons about trading Chinese stocks.
The precipitous fall in Hong Kong's market sent investors on edge in the past week. For the first time, the boon of an online trading link with Shanghai turned to bane. Two-way cross-border flow merely exacerbated the sell-off. Elliot Lee, who's been in the business for 15 years, has never seen anything like this since the global financial crisis in 2008.
Indeed, we are all shocked on how the magnitude of the drop in the last week, especially in the last week, which I guess we haven't been experienced such a huge drop in such a short period.
Hong Kong authorities were quick to allay fears. Hong Kong's acting financial secretary advised investors to stay calm and beware of risks in the market. Kenny Tang, who's also been in the business for 15 years, assured clients the rout was a mere short-term correction.
I think the Stock Connect prospect is still good because in the China, the wealth of the citizen is quite very substantial. So if we can channel some fund to the Hong Kong market, then I think the Hong Kong market will benefit.
The ensuing recovery in Hong Kong following Beijing's series of measures on its own markets brought some buyers back, but they came back surviving the fall, bruised and burned. The market rout taught them a gem of a lesson. Cross-border trading not only facilitated a quick flow of money, but the quick outflow of wealth when risk is up. While Kenny and Elliot agree it's a new trading era with the online cross-border link in place, the simplest of all investment advice still holds true up to this day.
I suggest investors to put about 20% stop loss. If the share price drops more than 20%, I think we need to sell down and wait and see.
They have to revisit their portfolio from time to time, monitor the portfolio and watch the news to see whether there are new regulatory changes, especially from the Chinese government.
Michelle, Lee was quick to add global events such as the Greek debt crisis or an interest rate hike from the U.S. Federal Reserve would also affect China's stock markets, but none will be as influential or, in his words, as powerful as any sort of development coming from the mainland. Michelle?
All right, Cathy, so how are investors hedging risk now that they've learned firsthand just how risky this market can be?
Yeah, you know, markets have been pretty volatile since the start of this week. So Lee is advising clients to reevaluate their portfolios. Don't waste time, he says. Do it now. Sell shares in companies that don't have sound business fundamentals, companies that professionals call shell stocks that have real high valuations. So his main advice for the mom and pop retail investors who account for most of the trading in China: balance your portfolio and reduce the number of risky bets like startups to start with. Back to you, Michelle.
Balancing portfolios and diversifying, always good investment advice. All right, thank you so much, Cathy Yang, live for us from Hong Kong. And coming